So what's new for 2022? We're going to talk about some of the tax changes that are afoot. We're joined in this segment by our fellow certified financial fiduciary and IRS enrolled agent, Christina Lam. Welcome to the program.
Thank you. Good morning, everyone.
Very good indeed. So never too early to start thinking about next year.
Absolutely.
Even though this year's tax season hasn't totally wound down.
Yes, we still have about a month left, a little bit longer. October 17th is the deadline for any of you procrastinators still out there.
Okay, so that means the 15th must fall on a Saturday, because I said earlier in the program it was the 15th. So we're getting the extra 2 days.
You get an extra couple of days. Yeah.
I got you. For the real procrastinators, you can just wait on through the weekend, that is for sure. So, but yeah, a host of changes in this segment. The next, we're going to start to kind of get into scratching the surface on what they look like. What's sort of what's the first thing that sort of comes to mind?
So the first is just the tax bracket increase. This generally happens from year to year, but across the board, they've gone up in the different brackets from 3 to about 3.8%. So a little increase there. However, given inflation is currently at 9%, it's a little lacking, to say the least.
3% sounds a little light. So what happens, though, each and every year is like the amount of income that's like subject to, like, say, the 12% bracket. Mm-hmm. That amount of income gets adjusted based upon these kind of inflationary types of increases, so that more of the income gets taxed at the 12% kind of thing. That's how it sort of works. But in a year where you've got high inflation and those dollars aren't worth as much, then 3-4% isn't the same as 8 or 9.
And they generally don't go back down. So I guess there's some understanding as to why they're a little less than the 9%.
Yeah, it is. One of the things that we see, speaking of inflation and inflationary increases, the biggest thing that we see is that there has never been an inflationary increase on some of the thresholds that exist for taxation of Social Security, and I think that's a real issue that folks are seeing on a regular basis.
Yeah, I would agree. Absolutely.
Because those thresholds haven't been increased, then more and more Americans are seeing that their Social Security is in fact taxable, and they need to pay taxes on that Social Security. And when the program originally started, that certainly wasn't kind of the intention. It was only meant to sort of capture tax on the people that were making higher levels of income. But because the threshold hasn't ever increased, then it continues to wind up being a pretty significant impact on most people's tax returns. So that's it for the increase in tax credits. What about the increase in tax rates and tax income brackets? Certainly there was a lot of tax credits that happened over the past couple of years. So catch us up on what's happening on those.
Yeah, so the first one that comes to mind is the child tax credit. So if you recall, in 2021, you would receive a tax credit for every child who is a dependent on your return under the age of 17. Now, last year we got $3,600, and I say we because I have a child, but you could get up to that amount, and it was also given to you in advance payments. So this definitely caused some issues on tax returns. Certainly we saw here in the office people couldn't remember if they received the advance payment, and then some of them, due to influx in income, had to pay some of that back.
Oh, sure.
So this year, for 2022 tax year, that's dropping back down to the $2,000 per child that is a dependent on your return.
And no advance or anything like that. None of the stuff that we saw last year.
Thank goodness, because I feel like that was, as somebody who helps prepare returns, that was definitely a difficult portion for people to keep up with.
Good for the people that got it, but certainly not easy, because it was really convoluted. Some of the documentation that the IRS sent out, was the same to both the husband and the wife, and so it really took some time to sort of figure that out.
Yeah, definitely.
And frankly, a lot of people would argue, I mean, there's certainly an argument out there that a lot of this stimulus money that was put into the economy during the course of 2021 is in fact directly contributing to how high inflation is today.
Certainly. I mean, I know my family noticed a difference, and I was like, oh, how come it seems like we had more money last year? And then as I look back at things, I was like, wow, we got quite a significant amount throughout the year with the 2 stimulus payments and the child advance credit. So there was a lot of money that, was on the table if you were eligible.
There's certainly some estimates that suggest that these federal government bills and stimulus checks and extra tax credit contributed almost 50% of the current inflation that we're seeing across the board. So besides the child tax credit, which obviously was a big part of sort of those additional payments, there was another one that had to deal with kids, right?
Yep. So there is the dependent care qualified expenses. So this is a deduction if you have a child under 13 who is a dependent on your return, and they go to some sort of either daycare, after school program, summer camps even are eligible. You can deduct up to 35% of the cost of that if you fit into the eligibility brackets. So last year it was $8,000 for one child, or $16,000 up to for more than one child.
That's a big difference. I mean,
yeah,
really
and it dropped back down this year to the regular rates of $3,000 for one child up to, and $6,000 for 2 or more children.
I mean, that's a $10,000 swing.
Huge.
Which I guess also one of the things that folks need to be aware of, and particularly why we wanted to have this conversation today, while there's still at least some time left in the year, if you think you're going to get these tax credits
right.
for the next year, you're not. They're gone. So if you got a refund by virtue of these credits, you're going to have a surprise come April where you're going to owe money because you do not have these types of credits on the return looking ahead to 2022. So it's not too late to try and plan, if you will, for that. Maybe boost the tax withholding, things like that
right.
work, things like that to help
extra
avoid
retirement contributions could also help.
Sure.
Potentially.
Sure. No, that's exactly right. So those are kind of the big tax credits that were happening. We'll shift over sort of to the itemized side of things. So a couple of different things going on that front as well.
Sure. So mortgage insurance premiums used to be an itemized deduction, and those were taken away. So those are set to be back on the table as long as Congress doesn't, disallow it between now and then. So mortgage insurance premiums are what's called PMI. And so if you generally don't put 20% or more down on your house, it's the insurance that's built into your mortgage payment that helps for loan default.
Sure.
So for some people, it can be quite significant. So that can be an additional deduction added to your itemized deductions for the year.
The thing that has always driven me crazy about PMI is that you pay it as the consumer,
mm-hmm.
right?
Yep.
And it does absolutely no benefit to you. Yes. Because it's not insurance for you if you can't make your mortgage payment. It is insurance for the bank if for some reason they have to foreclose and what they're able to sell the house for isn't enough to pay off your mortgage.
Yeah, absolutely. And I think an interesting fact I like to mention to people is that if you've had your house for a while and you have some equity in it and it gets to that 20%, some mortgage companies will actually allow you to drop that from your mortgage payment, but it's based on your paperwork and your loan documents. So every company is different. You just got to check with them.
And certainly stay on top of that, particularly if you've been in your house for a little bit. Given the fact that real estate here in Central Florida is certainly
mm-hmm.
appreciated well, you may find that you're in a little bit better position to sort of make that argument to avoid that one. So what's next on the list?
So next, also along the itemized deduction is the charitable giving deduction. So charity has always been a function of your itemized deductions. However, last year there was an additional deduction that you could take. It was $300 for individuals or $600 for married couples, and you didn't have to itemize to utilize that deduction. So since the standard deductions have gone up so much, most people haven't been able to itemize. So this was a little extra help on your tax return to have a nice little deduction for those charitable givings.
And at least get some benefit for making that charitable contribution.
Correct.
Now, when you and I talked about this earlier, I was surprised that this one went away because I thought this one was one of the more permanent ones.
Yeah, I was shocked myself. I thought that they would sort of keep that around. I mean, number one, it's great to give back to the community if you can. And
sure, good results. So we're going to take a break. When we come back, we're going to continue the conversation here on Dollars and Cents with Joel Garris and Christina Lam of Nelson Financial Planning.